Hello, welcome back. Disney is becoming a stock that is kind of trending right now, and you will see it even here in the module, in the stock news module, where a lot of articles are talking about Disney, and you'll see here that they mention Disney's invasion as a streaming disruptor and the fact that it is down 30% and it's a potentially interesting buy now. But we don't really pay attention to this kind of information, this kind of news pieces. What we do pay attention in is the stock analysis tool and the charts that we can see from the tool and all the financial metrics. And so as you will see here, in the last month, the stock has been going down from about 148 over here down to 131 as it is today. And you will see, if you take a look at the max chart, that Disney has been doing perfectly awesome. Because it has been up and up and up and up with some disruptions, of course, back in 2018, and now it has actually dropped quite some, but you would kind of expect it after this massive run that it had up to almost $200 here. So let's take a look and see whether it's actually worthwhile to add Disney to our portfolio right now. You will see here that it has a PE ratio of 78.4, and it actually used to be double that, which is insane. It's a lot. And right now it's a little bit better, but just from the PE ratio, I cannot really deduce whether the company is expensive, the stock price. I have to take a look at the stock projections, really, and we're going to be using the projections tool. Now, the price to free cash flow ratio is also very high, and actually higher than the price to earnings ratio. And also, Disney has been taking advantage of the increasing share price, and it has actually issued more shares here, as you'll see. So in the last 5 years, they have actually increased their outstanding shares, basically diluting an investor here, so it's not a good thing. And this is a very interesting one as well. Free cash flow to total liabilities is 55, which means that it would take 55 years for the company to pay the whole amount of total liabilities that it has using the free cash flow of last year. So that's interesting. It looks like the company has a lot of liabilities here that are underserved. Now, the 5-year revenue growth has been about the same. It is a company that doesn't grow much, but it's still growing. So, there is a little bit of growth, but 22% in 5 years, it's basically a value stock right now. And you will see here that the 5-year net income growth is actually negative here. It has actually dropped a lot off a cliff, really. And I'm pretty sure that has a lot to do with the pandemic. So this could actually be an opportunity depending on what we see in the stock evaluation field. Now, the 5-year free cash flow growth is positive, but we want to examine where this growth comes from, because the net income growth has been stalling a lot, and so these values are contradicting with each other, and so we need to actually discover why that is happening, and we will do that by taking a look at the financial statements, obviously. And the total equity has actually also been going down. Again, the company has been losing a little bit of equity, but they do have a lot. They're a massively rich company, very popular company, so this is probably not a big concern. Other than that, the returns have actually dropped, the margins have dropped here, and so yeah, we're looking at a company that is, I'm seeing here, trying to exit the pandemic phase and kind of enter its normalcy. Let's take a look at the income statement now. And you will see here that the revenue of the company, yes, has been increasing. But what about the net income? The net income over here has been negative in 2020, that is. And so in 2021 has been marginally positive based on, if you compare it to the previous years. So it does look like the company is actually returning back to profitability after a year of, of the pandemic, where things have been terrible for everybody, for lots of businesses. It looks like they will be getting better. In 2021 was a better year, so we're expecting the company to actually have even better years in the future. So the balance sheet over here, you will see that they did have a lot of assets. So the total equity is still growing, which is great. But they have also been issuing some shares, which is also worthwhile noting. But yeah, the total equity of the company has been growing a lot, and even though they have a lot of liabilities, they do have a lot of equity as well. Their liabilities are quite some, though. This is a massive amount of liabilities, so I would look to bring this down a little bit. This is quite some. Okay, what about the cash flow? Because that's very, very important, the lifeblood of the business. You will see here that it's 5.5 billion is the net cash provided by operating activities. But look at the depreciation and amortization here. This is like Netflix, like it's a lot of amortization, I'm assuming, from streaming services or something of that sort. because basically all the cash flow is provided by this depreciation and amortization, which is excluded from the net income. Of course, it's actually added to the net income as an expense, but it's actually added back here as a cash flow addition here, because it's not a cash flow expense, so it's added back to the cash flow statement. And if you excluded that, you would have a very, very low net cash provided by operating activities value, which would bring the free cash flow to negative territory, and this is not happening because of the depreciation and amortization here. So right now we are looking at the company in 2020 and 2021 that actually all its cash flow was generated based on the depreciation and amortization that the company had. Now, that wasn't the case back in 2019, though, where the net income was 11 billion here and 12 billion here. So 4.16 was depreciation and amortization here, which would bring it to about 8, probably 10, if you add that extra billion over here. So the thing that I want to examine next is I want to use the stock evaluation tool here, and I'm gonna be a little bit aggressive with my projections because I do expect that the revenue growth of the company is gonna be better in the next few years. So I'm not gonna be very conservative here on purpose, because we're examining the next 5 years, and I do want to be a little bit aggressive because the company has been slacking the pandemic slumping, and that made sense because of the conditions of the market. But right now, as we are exiting the pandemic, I think I want to be a little bit more aggressive with my revenue growth estimates here. So I'm going to go a little bit more aggressive here, probably quite some aggressive really. 7, 8, and 9 is what I'm going to do, which is much more aggressive than the previous years. And the net income margins have been kind of killed for the company the past couple of years, but before that they were a little bit better. So I'm going to go 15 here. Let's go 15, 17, and 19. And the free cash flow margin over here, you will see also had a year where it was negative, of course, and killed back in 2019 too. So as I'm still going to be using something that's more normal, 70, 80, and 90 here, and 13% is what I want to be making out of my single stock investments for the most part, unless they are very, very risky, in which case I like to try for a little bit more. So let's take a look and hit calculate here. And you will see that right now, based on these estimates, which are a little bit aggressive, we are still below our current price with our max price to pay for today. So the company is still expensive based on what it's doing, and based even on kind of aggressive projections here. So even let's just say that I go 12 here, 12, 14, and 16. What's going to happen then? So in this case, we're just getting the high estimates within our price range here. Even our medium ones are not within that, with a 15% revenue growth, which hasn't happened. Actually, has happened once in 2019, 17%. But this is very aggressive. So as you can see, while I like Disney and I think they will come back, I think it's a little bit expensive right now. So it may be best to actually avoid. I wouldn't be surprised if it rises sharply at some point, but it's gonna be a little bit expensive to buy right here. So tell me what you think about Disney. It's definitely not too bad, but again, I feel it's a little bit more expensive than I would like. But do tell me if you own it or if you're thinking about buying. Leave a comment below, let me know. And if you did enjoy the video, please leave a like and subscribe if you're not a subscriber, because very, very soon I will be giving you access to this tool if you're around. So thank you for watching this one, and if you did enjoy this video, take a look at the one that I made earlier, and I'm talking about Alibaba and what is happening with the company right now. Thanks for watching, and I'll see you in the next one. Bye!